Hi, I'm Jessica Rabe, co-founder of DataTrek Research. Today I'm going to compare U.S. small cap equities to their large cap counterpart because small caps have increasingly become a very different animal over the last 10 years relative to prior decades. Simply put, they went from being reliable outperformers and therefore great investments to a short-term trade that needs to be well timed based on certain factors that we'll cover later on in this video. First, let's look at the major differences between what's in the Russell 2000 and what's in the S&P 500. Because the Russell doesn't own big tech, its sector allocations are very different from the S&P. This table compares the Russell and S&P's weightings and breaks down how big tech's 31% weighting in the S&P is redistributed to other small cap groups. Whereas big tech represents nearly a third of the S&P, the Russell overweights four cyclical sectors, which are industrials, financials, materials, and energy, two rate-sensitive groups, real estate and utilities, and one growth sector, healthcare. U.S. small caps are therefore a levered play on the U.S. economy, while large caps are a levered play on disruptive innovation at global scale. So although U.S. public companies make up both indices, they have very few similarities otherwise. Next, here's a table with the S&P's and Russell's top 10 holdings. The S&P is more concentrated than the Russell, with its top 10 holdings making up over a third of the index versus just 4% for the Russell. The former is dominated by global leaders in huge markets, while the latter is more specialized and focused, and the stocks here play far less of a role in index-level returns. Now let's move on to how these two indices have performed over the medium and long term. Here's a table that shows the Russell and S&P's cumulative total returns over the last 3, 5, and 10 years. This data is as of February 28, 2025, the latest available information. U.S. small caps have grossly underperformed large caps over each time frame. So to put this data in perspective, the difference between a 43% and 10% 3-year cumulative return on a $1 million investment is $325,000. The difference between a 118% and 56% cumulative return on a $1 million investment is $618,000. And lastly, the difference in performance between a 238% and 100% 10-year cumulative return on a $1 million investment is $1.4 million. Simply put, any allocation to small caps over these time horizons has been a tremendous drag on portfolio performance. The upshot here is that U.S. small caps are no longer just a riskier and potentially more rewarding version of U.S. large caps. Owning dramatically different sorts of stocks leads to dramatically different performance. This chart of 1-year trailing daily return correlations between the Russell 2000 and S&P 500 since 2004 reflects the changing nature of these indices over the last 2 decades. As a reminder, correlation measures how closely two variables relate to each other. A correlation of plus or minus 1 reflects a perfectly positive or negative linear relationship. A zero correlation says there is no linear relationship between the two variables and that they move independently of one another. And lastly, anything in between indicates some relationship, and the closer it gets to plus or minus 1, the tighter it is. So 4 points on this chart. First, from 2004 to 2013, the average 1-year correlation of daily returns between U.S. small caps and large caps was 0.19, which in statistical terms is an R-squared of 83%. This means that 83% of small caps price action could be explained by what was going on with U.S. large caps on a given day. That's a strong correlation, and as you can see in the chart, the trend was to an ever stronger relationship over time. Second, their one-year correlation dropped to an average of 0.86 from 2014 through 2019 and an R-squared of 74%. Just as importantly, the change in both the direction of the correlation trend and its volatility is truly remarkable. Third, even with the two spikes in correlation since 2020 during the pandemic crisis and 2022's rate shock, both due to the fact that correlations always spike in a bear market, the average dropped further to 0.84, or an R-squared of 70% from 2020 to now. Fourth and lastly, the all-time low in the Russell and S&P's one-year correlation was 0.69 at the end of July 2024, an R-squared of just 48%. Even with the latest sell-off in U.S. equities, it was most recently 0.78, or an R-squared of only 60%. So the takeaway here is that U.S. small caps have been increasingly charting their own path over the last 2 decades, and far more than many investors likely realize. As for when it's worth owning small caps over large caps, here's a chart that shows the one-year trailing relative price returns between the Russell and S&P from 2004 to the present. When the blue line is above or below the x-axis, the Russell has out or underperformed the S&P by the number of percentage points on the y-axis. I have 2 points on this chart. First, this table shows that the Russell has been slowly losing its performance edge versus the S&P over the last 2 decades. The Russell did much better than the S&P from 2004 through 2013, outperforming by an average of 3.6 percentage points over any given one-year holding period during this time frame. The Russell's win rate was 68%, meaning small caps beat large caps 2/3 of the time over the prior year during this period. But small cap relative returns started weakening from 2014 through 2019, with the S&P outperforming the Russell by an average of 2.2 points over any given one-year period. The Russell's win rate was only 36% over this time span. Even with small caps' massive run in 2021, they've seen their relative performance versus large caps further worsen since 2020. On average, the Russell has underperformed the S&P by 5.3 percentage points over a one-year holding period from 2020 to the present. The Russell's win rate has only been 22% since 2020. The upshot here is that although U.S. small caps used to be reliable outperformers, that's not been the case over the last decade. As for why, consider that big tech has gone from making up 10% of the S&P the S&P 500 in 2014 to 31% now. Second, since 2020, it has taken a dramatic and typically prolonged underperformance for U.S. small caps to outperform large caps. More specifically, this chart shows it's taken 20.2 points of underperformance, which is two standard deviations below the long-run relative mean since 2013 for U.S. small caps to mean revert and temporarily outperform. The Russell hit that threshold in 2020 before having a massive run versus the S&P during 2021's pandemic-fueled speculative bubble. Early in the current bull market, after 2022's bear market, and 3 times in 2024 before finally bouncing in Q3 last year from lower rates. These outperformances, particularly the last 2, were short-lived, however, as U.S. big tech is better able to leverage new disruptive technologies like Gen AI with their massive cash flows, high returns on capital, strong market leadership, and global scale. The mid to late 2010s is another good example of big tech overshadowing their small cap counterparts by dominating the growth of the mobile internet. To wrap up, we think of U.S. small caps as a trade rather than a long-term investment, and outperforming large caps requires a combination of lower rates, a positive outlook on U.S. economic growth, and a statistically significant underperformance from which to mean revert. There will be a time when small caps make a great trade, but we don't currently meet all three conditions for that to happen just yet. If nothing else, investors first need a much clearer sense of the economic impact of President Trump's policies, as well as how the Fed may respond to the collective effect they have. Ultimately, history shows the stocks that are best able to leverage disruptive innovation, such as U.S. large cap stocks, which are a huge slug of the S&P 500, tend to perform best over the longer run. Thank you very much for taking the time to watch this video. Please hit the like and subscribe buttons if you enjoyed it. You can also sign up for a 2-week free trial to receive our daily investment newsletter on datatrekresearch.com. Thanks again for watching, and we hope you have a great day.